Let's talk about this FX market, driven in the first half of this year by perceived capital flows. Do you believe that in the second half of this year, it will be driven by rate differentials, and why?
Rate differentials up to a point, expectations about growth, which are often the same thing. But yes, I think that people are genuinely uncertain in the sense of, at the moment, they're uncertain but aware of the fact that the world is very long dollars because we've all put so much money into the US equity market, because money's gone into the US Treasury market, because the US has been outperforming for so long, and that if the economy slows, rates need to come down significantly, then some of the returns people have enjoyed are pretty vulnerable. I think the market's confused about the short-term rate story, but confident that the answer is the US economy slowing a little, or is it in more danger of a more significant slowdown? And that means we're overreacting to every single piece of macroeconomic data, with the exception perhaps of the really sort of minor data we saw yesterday. But we're lining up to overreact to each piece we get going into September.
Taking a step back, Kid, earlier this year, it seemed like a one-way freight train of sell dollar, sell the United States. That was the trade, and pretty much everyone lined up behind it. Is it over? We've kind of plateaued and kind of shifted around this level for a couple of months now. Are we seeing sort of the end of the sell the America trade and going back to this sort of nuanced, overreacting to every data point type of landscape?
I think the data will decide that. I think the question then is whether the US economy is slowing significantly. I mean, a currency can't go down as fast as the dollar did, or go up as fast as currencies like the euro did for very long. An inflation targeting central bank reacts to fast currency moves. An economy reacts to fast currency moves. So the move we had in euro dollar from 102 up to 118 was too fast. We have to take time out. Whether that takes us to 125 or we get stuck here depends on how much or how little the US economy slows in the next 3 months, I would have said. And if we got a repeat of last month's payroll numbers, if we got something genuinely soft, then I think we're going to head off into the middle of the 120s for euro dollar. We've got another 5 to 10% weakness in the dollar in this cycle to come. But you know, I wouldn't want to overinterpret some of the data that we've had in the summer and extrapolate it out blindly as saying that is what's definitely going to happen. Again, if the inflation hit from tariffs isn't too big, the economy's not going to slow too much, and a very gentle easing in US growth doesn't justify much dollar weakness at all.